Could we, so why doom and gloom? We had, I guess there were a few laughs about the title of it. We named the presentation prior to Ben Bernanke with possibly a better explanation of a massive fiscal cliff in our future. So we've been hearing a lot in the news about this fiscal cliff. I wanted to explain what it is, and really it leads into what it means for tax policy and tax law changes going forward. On January 1, less than 2 months from now, we are facing substantial changes not only with the expiration of the Bush tax cuts, the expiration of a lot of different tax laws, but also mandated spending cuts. In going through the negotiations last year in November for the raising of the debt ceiling again, in the negotiations they agreed to $917 billion in mandated spending cuts, everything from defense, discretionary spending, really across the board cuts. So what we're going to see if nothing is done is a huge increase in the tax base, a huge increase in the taxes that are paid, which is reducing the money going into the economy from people like you and me. It's going to the government instead of going back into the economy, while at the same time the government will be shrinking its spending. So it's a big hit to the economy. If the tax cuts expire and spending cuts are made, the Congressional Budget Office predicts that we go into another recession. So that's the one choice is follow this path, go into recession. However, extending the tax breaks and canceling the spending cuts are projected to add another $7 trillion in debt over the next 10 years. So do we continue to borrow? Do we take the cuts now is really the decision. The Bush tax cuts were actually scheduled to expire in 2010. It had a 10-year life. In 2010, they were extended for another 2 years because the economy was deemed to be very fragile at that point. And now we're facing another decision point on what needs to be done. So what's the political outlook? We'll start with the Republican position. Now, we all know the results of the election last week. Hopefully we're over the hangover from that. The Republican position is still important. The Republicans still control the House, and all tax bills originate in the House. So they do still have some control, and there needs to be negotiations between the White House and the House. The Republicans would like to extend the Bush tax cuts pending reform of the tax code. So their first position is essentially to punt it again and have another extension for a year or two while we can figure out what the real changes are going to be. They'd like to reform the tax code by reducing marginal rates by 20% across the board in a revenue-neutral manner. Now, how do you do a 20% tax cut and remain revenue-neutral? We've all heard talk about lowering the rates and broadening the base, and this is really what they're talking about. Has a nice ring to it. What it means, though, is that when we calculate income taxes, say for individuals, we have the income that we include with the tax return, and we also have deductions. We're allowed deductions for our mortgage interest, for charitable contributions, for medical. We receive credits for having children. We receive exemptions for having children, credits for tuition, various different things that reduce the amount of the taxes. So what this broadening of the base means is really eliminating some or all of those deductions. So potentially we see decreases in the benefits allowed from things like mortgage interest and taxes, state and local taxes that you pay. They want to eliminate the taxes on interest, dividends, and capital gains altogether for lower and middle income taxpayers. That's probably not a huge revenue costing item. Typically lower income taxpayers don't have a whole lot of investment income. So not a big cost there. Republicans would like to end the estate tax, or the death tax as they refer to it, as well as repeal the alternative minimum tax. President Obama's position is a little bit different. He believes that the tax system should be simplified with lower individual and corporate tax rates and fewer brackets. So again, we see the same position of lowering rates. and simplification. Now, simplification, we've been talking about simplification forever. And if we've gotten anything over the last 10, 15 years, it's not simplification. It's exactly the opposite. More and more targeted tax breaks, more and more deductions and credits that apply to a narrow sliver of the taxpayers, anything but simplification. Tax breaks that are inefficient, cutting tax preferences for high-income households. Again, that's reducing the tax preferences would be your mortgage interest, your charitable contributions and whatnot. Eliminating special tax breaks for oil and gas companies. We heard a lot about that during the elections. Closing loopholes for investment fund managers. There's an interesting way that fund managers are taxed. They actually can share in the profits of the funds. So a lot of their income is taxed at capital gains rates and dividend rates instead of being taxed as compensation. There's been a lot of talk about that. While it may be a valid change, it doesn't generate a whole lot of revenue when we're talking about the deficit levels that we have. And also eliminating benefits for corporate jet owners. So again, targeting at the so-called rich. Cut the deficit by $1.5 trillion over the next decade through tax reform, including expiration of tax cuts for single taxpayers over $200,000 and married couples making over $250,000. So a line seems to have been drawn in the sand here where the rich are defined as married couples at $250,000. And I guess below that is where the middle class falls. And lastly, the Buffett rule, which no household making over $1 million annually should pay a smaller share of their total income in taxes than middle class families. And really what this is getting at is the capital gains tax rate. And we are taxed currently at 15% on long-term capital gains. That's investments that have been made for more than a year, sometimes for many years. They've been held for a long time, and they get taxed at a preferable rate because of the risk that's taken and the long-term holding that's needed in order to attain that. We're also taxed at that rate on dividends that we receive from companies that we invest in. The reasoning behind that, and right or wrong, is that those companies have already been taxed on that money. Those corporations have already paid tax at 35% to the federal government, maybe another 10% to the state governments. So they're left with 60 cents on the dollar, which they pay out in dividends, and it's taxed at a preferential rate to the taxpayers because of that. The president wants to eliminate that and go back to an ordinary tax rate. The issue is that for $1 of income that you have from at the corporate level, net of taxes, you end up with 30 or 40 cents to the individual. So the government's taking certainly more than half of that income. So where do we have overlapping goals? The two parties during the elections, we seem to be absolutely opposed to each other and where we should go with tax policy. They both agree on tax simplification. That's easy to say. It sounds really good in a political speech, but so far we haven't seen much of that. Tax cuts and or no increases for middle class families. And we'll get into that. We're drawing the line for middle class at $250,000. So the idea is that we're going to balance the budget entirely by taxing those over $250,000 and not increasing any taxes on what really is the vast majority of Americans. Reduction of tax benefits to the rich. There has been agreement on this, again, with the lowering the rates and the broadening of the base. And impacted in that is mortgage interest, charitable contributions, state and local taxes, real estate taxes, and so on. And both parties do agree that we should have deficit reduction. I think that kind of goes along the line of tax simplification. It's easy to agree that we should do it. And a point with the deficit reduction, we're hearing a lot of talk about reducing our deficit. There's two different things out there. The deficit is the amount of money that we borrow each year. And there's a lot of talk about reducing how much we borrow each year. There's not a whole lot of talk about reducing the amount of our debt and paying down our debt and being more fiscally responsible. So we'll get into that a little bit later on. So where are the negotiations going? In the Washington Post yesterday, President Obama is taking a hard line with congressional Republicans heading into the negotiations over this fiscal cliff. He's making no opening concessions and calling for far more in new taxes than Republicans have so far been willing to consider. He believes that he's received a mandate in the election that he needs to move forward with taxing the top 2%. Timothy Geithner said, I don't see how we can do this without higher rates. And this is in response to the Republican position of we don't increase the rates, we just broaden the base. We reduce the benefit of some of those deductions without increasing the rates. Geithner says when you take a cold, hard look at the amount of resources you can raise from that top 2% through limiting deductions, you'll find yourself disappointed relative to the magnitude of the revenue increases that we need. So just reducing the deductions, the benefit from those reductions is not enough. We need to increase the rates as well on that top 2%. And Jay Carney, the White House press secretary, I thought had the best quote here. He suggested that even revenue generated by letting the Bush tax cuts end would not be enough to tame the national debt and re-energize the economy. So somehow the press secretary is drawing a parallel between increasing taxes and somehow that will energize the economy. That's a new twist on economics.